Lesson 1, how to think about stock valuations. For this lesson, we have two quick learning objectives. The first one is valuing a stock versus valuing a home. And the second learning objective is how to be rational in stock valuations. So let me tell you about my first stock purchase. It was a company called Coloplast that developed, manufactured, and marketed medical devices. And you might be thinking that I had some special kind of knowledge about the company before I made the investment, but if that's what you're thinking, you're definitely wrong. So you might be thinking maybe you were looking at the financial statements or you were doing discount cash flows to figure out the intrinsic value. That definitely wasn't the case either. And I'm pretty sure that none of that would have made any kind of difference because I had no idea what any of that stuff even was whenever I made my first stock purchase. So really the criteria that I was using, I read an article that said that, the average return on the stock market was around 8% annually. And if I purchased enough shares of different companies, call it 20 different companies, I was going to make the same thing. I was going to get an 8% return. And it really didn't much matter, too much about what companies I actually selected because I figured the good would wash out the bad and I'd get my 8%. Looking back at this, I can't believe how I made my analysis at the time, or rather lack of analysis. And I'm not proud to say that the stock did actually do well, and I made actually 30% on the stock. But the truth is that it was pure luck, and my ability to pick it had nothing to do with the success. You can attribute nothing more than an embarrassment to that return and not to any type of skill in any possible way. However, what I found after talking to hundreds, if not thousands of stock investors, my story is sadly more the rule than the exception. Most people kind of start off in this in this horrible analysis phase. For many reasons, it's simply harder to evaluate a stock than a hard asset like a home. So let me give you an example of what I'm talking about. So say that you're asked to value a home in your neighborhood. Without being an expert, you would quickly ask the question about the location, the number of rooms, the year it was built, the square footage, and all that kind of stuff. It just kind of comes intuitive. If I told you to go to a different state or perhaps even a different country, you would still ask kind of the same questions, and you would likely also check what comparable homes have been sold for that are pretty comparable to the house that we'd be trying to value. The key thing here is if I told you the house was $250,000, you wouldn't just say, oh, okay, $250,000, let me pay for it. You would go and you would substantiate that price. You'd do some type of homework to validate whether that's a good price or a bad price. You would do that immediately. It doesn't matter what it is. And so the thing that's surprising is for a lot of investors, including myself whenever I first started off, people don't do that. And for whatever reason, they treat it differently than they would treat a house. And so what I would probably label this as is people get bogged down whenever they make that leap from doing the assessment of a house, which they understand, to a stock. A stock is not something that they intuitively understand, where a house is. And so they get bogged down into the details because they can't see the big picture. They can't come out and see all the different key variables that are at play when they're talking about a company or a stock. And so what you typically hear people say is, oh, I bought the stock for $30, and since it's at 20 now, I'll just hold on until it comes back up to 30 and then I'll sell it. But they really don't know what that 30 or that 20 even represents. That's a key hurdle and a key difference whenever you're learning about stock investing and you're trying to figure out the intrinsic value of something. That's what we're really talking about here, is that you actually understand what the $30 or the $20 really represents. So let me talk about something that I think a lot of people get mixed up whenever they're first entering the stock market. They'll read something in the newspaper that says a company like Chipotle, the US-based Mexican food company, would be expanding into India. And so somebody who would read that article would potentially jump to the conclusion, well, if they're expanding into India, they're going to have that whole market. Their stock's going to explode because they're going to be able to produce, tons more revenue and bottom line profit. And so people will stop their analysis after thinking through why the company moving to another country might be good. But with just a little bit of analysis, we could quickly prove or disprove that theory. So let's say that Chipotle's revenue, which is their top line, that's how much money the company's bringing in before any expenses or anything. So let's say that their top line, they're bringing in $4 billion. Okay, and this is before any expenses. So after expenses, let's say their expenses are $4 billion, the company literally made zero profit. That could be a scenario. Okay, I'm not saying that that's the scenario with Chipotle. I'm just saying that that could be a scenario. So when you start understanding the numbers that are behind the performance of the entire company, and it's really important to look at it from that perspective, when you're looking at that, now you can put more light on the news article that you just read. So as maybe you're reading that news article, it might say something like, the company expects to increase their revenue next year after moving into India by an additional $50 million. So when you would look at that comparison, that the company is currently making a top line revenue of $4 billion, and the movement into another market called India, that $50 million is literally like nothing compared to the overall $4 billion that they're currently producing. That is a quick comparison to quickly understand why that might not make the stock price jump, or it shouldn't make the stock price jump if you're an intelligent buyer and a person who's trying to really understand why something should or should not go up or down. So let's talk about the second part of what I was describing before, where a person would say, I bought it at $30 and it's at $20, but let me just wait and see if it can get back up to $30 before I would sell. So the first thing I got to say is, why would you be willing to sell if the stock comes back to $30? Because the real value might be $60. You might have just seen it go down to $20 because the market's trading it all over the place with news and people not actually understanding what they're doing, which happens. Why would you conditionally tell yourself, I'm going to sell at 30 when it gets back to 30? Because you have to do the analysis. You got to be able to fully understand what it might be worth. It might be worth $60. So you might want to continue to hold it even as it passes through 30 again, and you get your principal back on your initial investment. So the main thing that you're probably asking is, what should I be asking when I'm evaluating stocks? Just as you would seek information about a home before you bought it, you should do the exact same thing with stocks. Ultimately, you would like to know how much money the stock will generate, the profit that it'll make, and then discount that profit back to a value that you can figure out what it's worth today. And it all comes down to those future cash flows that you expect the business to make. And don't worry about that right now. That's definitely coming in some of the later videos. But this is just an overview of where we're going to go. And what you're really trying to figure out is, how much do I think, from a conservative estimate, is this company going to make in the future? I'm going to add up all those cash flows. I'm going to discount them back, and then I'm going to have a percent that I expect that company to yield if I can buy it at the current price. And that's what's really important, is understanding how to do that. So in the next learning objective, we'll investigate why, and more importantly, how to be rational in stock market valuations. So the skill set to estimate the intrinsic value is hard to acquire for a lot of people, simply because our natural behaviors as humans isn't really inclined to do this. But in this learning objective, what I'd like to teach you is how to break down the human habits so that you can fight the bad habits and really kind of come up with some rules that you can follow in order to do this successfully. And the thing that I think you're going to find kind of surprising is, estimating an intrinsic value is actually quite simple and pretty easy to do, but amending your assumptions and fine-tuning those assumptions that you're coming up with is the hard part, and that's the art that we're going to be able to help teach you. So let me cover the first human behavior I'd like to discuss, which is one of my favorite excuses. We don't have time, or I don't have time to analyze stocks. And so considering that more than half of Americans own stocks, you might find that to be a little bit odd that so few people actually know how to figure out what an intrinsic value is, or would even know what that is if you said it to them. And I would argue that it's really not that odd. Very few people find it interesting to sit down and read through a financial statement, a 10K or a 10Q. They probably look at that as almost like reading the dictionary. And in a way, that's understandable, because if you don't know how to do this, or you don't find it kind of like a puzzle that you're trying to unlock, a mystery of a value, it's going to look extremely dry, almost like you're watching paint dry. So it's very understandable that a lot of people don't know how to do this. And I think one of the other things that's really difficult for a lot of people is they don't understand the terminology. So as soon as they would look at a 10Q or a 10K, they wouldn't know the difference between net income, revenue, They don't know those key terms, which is almost like learning another language if you haven't been exposed to it a lot. So those are some key factors why I think a lot of people kind of default to the, I don't have time for this. And I think a lot of people might be pretty busy. And especially if you're dealing with 20 different stocks, it can get time consuming to go in there and review it. But we'll teach you in this course is I don't want to say there's shortcuts, but there's easier ways to go through and analyze a company. And the point where you really need to pay attention is in the quarterly reports. Some people might have the assumption that you have to look at the way your stock's trading every single day. That, for me, is very far from the truth. I really look at my picks just maybe once every 3 months to go back and read the 10Q or kind of look at any updates or amendments to the expected earnings that are going to be coming out for the company. That's where I really focus a lot of my attention. And for me, it really doesn't take all that much time. If you feel like the learning curve is too steep, or it's a lot of, checking and reviewing individual companies, for that type of investor, it might just be best to go do ETF investing. In fact, I think a lot of people fit into that category simply because they don't necessarily have the interest that you probably have from buying this course to go through and really learn how to get into the nitty-gritty and determine the value of an individual company. Definitely not a setback to be an ETF investor. In fact, I think a lot of people do individual stocks and they also do ETFs, which I think is a good strategy, and it'll help reduce some of your risks because you don't want to have too much exposure to an individual stock and only maybe have 5 picks in your portfolio. That might be a little too dangerous. Those are just some thoughts as you're thinking through how much time am I willing to put into this. If you have 5 individual stocks and then some ETFs, that might be a great mix because of your time and effort that you are willing to put into it. So the second human behavior that I want to talk about is losing. So the vast majority of people cannot stand to lose anything. And I guess that's a good thing. But the lack of fear of losing is very unhealthy for us in many different ways, and that especially applies to stock investing. If you want to learn a lot more about this topic, there's a gentleman called Daniel Kahneman, really well-known psychologist, talks about a thing called loss aversion. And without getting into too much of the specifics of it, the main thing that I think you need to really understand as a stock investor is that the human nature really works against you when you are a stock investor, because you'll have a tendency to forget everything that you have done your analysis on for the valuation, simply because you are trying to avert any sort of loss whenever you see a position start moving against you. So let me demonstrate this for you. So consider this. There was a study that was done with participants, and they were given $50 at the start. Then they were asked to choose between one of 2 options. The first option was they could only keep 30 of the $50. The second option was they could gamble with a 50% chance of keeping or losing the entire $50. So when you look at that second option, that's actually the worst of the 2 options, because if there's a 50% chance of keeping the 50 or 50% chance of losing everything, your expected outcome is actually $25 instead of the guaranteed $30 in the first choice. But what we find is that the participants acted in a risk-averse way. And so although the math on this is really easy to understand, in that study, 43% of people still chose to gamble with their money by taking the second option. So now let's look at the wording in the way that was described. So in the other one, we said that you could keep 30. But now the wording changed to you will lose $20 is the first option, or you can gamble with a 50% chance of keeping the whole 50 or losing everything. And the number of participants who decided to gamble in the second scenario, it went from 43% in the first scenario, clear up to 61% in the second scenario, simply because of the exact situation and the way that it was framed by saying you will lose $20. And so you saw the numbers jump by nearly 20% of people now definitely choosing the worst choice, which was the second choice. And in just the way that it was phrased, by losing $20 instead of keeping 30, you saw the numbers drastically shift towards more gamblers and people being impacted by this loss aversion. So intuitively, you might think that loss aversion might be a good thing as a stock investor because it will help you protect your risk or to not do anything stupid. But what loss aversion actually does for a lot of people that aren't aware of the intrinsic value of a pick, or they're just not have a lot of confidence in what they're doing, loss aversion will have that person sell as soon as that stock pick starts moving against them, instead of holding on and committing maybe even more of a position because the price got even cheaper. So what you find is a lot of investors, whenever they have a good stock or something that's in the green and it's actually gone up, they want to sell because they want this feeling of a win. They want to basically confirm that they had made a good selection. But the problem with this is if you bought it for $10 and you sold it for $15, but it's really worth $25, you just maybe made a major error in your decision making. But this all comes back to the psychological impact of losses versus rewards. So the solution to breaking this second human behavior is straightforward. You should not buy or sell your stocks based on which price you've bought them for in advance. What you need to do is continually look at what you think the intrinsic value of the company is, and then making that assessment of what kind of return you think you can get. And then you compare that to every other stock on the market and ETFs, or it doesn't matter, anything that has a yield to it. You're constantly comparing what that yield is on the company that you purchased. You take into account the capital gains that you'd pay, and you see what your new yield could be in maybe another asset class. That's how you're making that comparison. So let's talk about a third human behavior that we think is really important to highlight. And this is the idea that we prefer stories over data. So a narrative is something that's crucial for people to really kind of live their daily life. These narratives help us to explain things and understand and interpret the world around us. These narratives also give us a frame of reference to remember things. It makes it a whole lot easier for us to recall something. Something else that's important is that a narrative is a social concept. How many times have you been at a dinner party and heard someone explain that they bought a given stock? They might have a narrative of something like, I've seen so many windmills go up around the state, and that's probably why ExxonMobil's price is going to go down. That's a narrative. That's something that has very, very little background information and data behind it. It's just a simple statement. And because of that simple statement, somebody has made a complete purchase and put a significant amount of their capital into that simple narrative and that simple thesis. So I'm sure you've quickly deduced what the solution for this one is. And that's that your analysis has to have a lot of data and not just a compelling story. In fact, the thing that Stig and I work really hard at doing whenever we come up with an idea of what we think might be a great stock pick, the most important thing we can do is try to understand any narrative that would disqualify our opinion or to prove us wrong is really kind of the direction that we start going. So we try to avoid finding more evidence to support our position. In fact, we try to look for the opposite of any type of opinion that would support our claim and try to identify all the risks associated with it. One could say that work should never be done. That should be something that, as an investor, you're constantly trying to identify all the risks that would be associated with proving your thesis or your opinion on why you own a particular company wrong.